Welcome to Get Rich Education. I'm your host, Keith Weinhold. Enjoy my chat with one of the most influential real estate investors and educators in history. He leads a company that owns $1 billion with a B dollars in apartments. It's the incomparable Ken McElroy today on Get Rich Education. MC Laubscher is the host of the Cash Flow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. Get Rich Education is brought to you by Ridge Lending Group, Producers Wealth, Norada Real Estate, and Total Control Financial.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE, from Spokane, Washington to Washington Heights, Manhattan, in New York City, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education, and I'm so glad that you're here, where you don't follow money, you make money follow you. Bringing it back another week because I've got that drive to help you build your wealth. Today's guest, Rich Dad Real Estate Advisor Ken McElroy, leads MC Companies and their 10,000 housing units, where they own, syndicate, and manage primarily apartment building properties. A lot of investors hang on Ken's every word and want to know what moves he's making since he's such a substantial industry influencer. Well, last time he was here, he told us how it's increasingly difficult to find apartment building deals that make sense these days. In fact, now he's selling 10 properties across Texas, in Tulsa, Oklahoma, and in Tucson, Arizona. Let's get right into it, as there's so much we want to discuss today. Debt mindset, his own deals, and how to manage your team. He joins us from Scottsdale, Arizona today. Today, and I'm going to say it, we are talking to a legend in real estate investing. As the longtime Rich Dad Real Estate Advisor, he's written so many books that have contributed to our field, both inside and outside the Rich Dad series, like The ABCs of Real Estate Investing, The ABCs of Property Management, and The Advanced Guide to Real Estate Investing. I bet you've read at least one, if not all of those books. He produces tons of popular instructional videos as well. Welcome back for your fourth Get Rich Education appearance, the one and only Ken McElroy.
Keith, thank you. Great to be on again.
It's great to have you here. Let us know what you've been working on lately, Ken. I know a lot of it has to do with mindset.
Oh, yeah. I always have been in personal development, but for whatever reason, the last few years have been all around kind of behavior, mindset, your belief system, those kinds of things. And Robert Kiyosaki and I and Kim and the advisors, we always pass books around. We're studying a book together actually this month in Scottsdale called The Power of Now, which I've now read 3 times and listened to the audio. I think it's just been an amazing adventure.
Yeah, I often talk about people kind of underestimate the now. They're always thinking about what they might be able to do in the future, but you often have more to work with now than what you really think, whether it's converting your IRA funds into a self-directed type of IRA and using those funds for real estate, or whether it's taking idle equity in your home and converting it into cash flow. There's a lot with the power of now.
Yeah, there definitely is. I think what happens mostly is most people are hung up with maybe something that's happened to them back before today. Maybe they lent money, or maybe they did a deal and didn't go poorly, or maybe they did a deal and did very, very well, and they think it's going to happen again, or whatever it is. There's so many things, mostly from the past, that people kind of bring into today, and I think a lot of times it shackles them on their full potential.
Now, you have this phrase of self concept, and so much of your investor self concept has to do with early influences in your life. And that's even true with you and your parents and your upbringing.
Yeah, yeah, for sure. And so one of the things that we talk about is like in self-concept. Self-concept is really your self-esteem, your self-confidence, whatever it might be. And so a lot of times, like for example, personally, like I grew up, my parents didn't finish high school, and we grew up pretty poor. And so my mother used to always say, "We can't afford that." And we couldn't. And so it was a true statement. So I had to break out of that personally, that mindset of, how can I afford that, from we can't afford that. And so those are the kinds of self concepts. Maybe you grew up in a broken home. You have to, I think, pull yourself out of those scenarios in order to be successful. You have to deal with those things and move on.
When you replace the phrase, I can't afford it, with the phrase, how can I afford it? That's when your mind begins working. That's when you start expanding your means rather than living below your means. Yeah, I kind of think of self concept as what you think of yourself. So, how can someone improve their self concept and think more of themselves?
Well, I think the self concept, it's actually as simple as just being aware of it. So, like one of the books that we studied, which was The Untethered Soul, for example, by Michael Singer, and this was a couple of years ago, it basically just talks about being the observer. So, when you have what's called triggers, or some kind of emotion that you may even not know about, whether it's conscious or unconscious, around a subject like money, as long as you're aware of it, then you can start to work on it. So, in other words, in the book, they call it being the observer. So, let's say I lent some money to somebody once, and now somebody's asking me again, present day, for money. Generally, you're thinking about that experience, if it was paid back or it wasn't paid back. And so you have
Yeah.
a trigger based on your experience. And so as an observer, you're kind of watching yourself, observing your behavior at that very moment, because the self concept does turn into your thoughts and your behavior.
Thoughts become words, words become actions, actions become patterns, patterns become you.
Right. It's interesting is some people carry a lot of baggage. Some people have been working on that baggage. So we're now getting into things like that. And it's really interesting because for me, what you find is that whatever you're doing, interacting with people or interacting in business or whatever it is, whatever you've learned up to that point kind of determines, what you're doing at that moment, your behavior. And I think that if you can go back and take a look at those, perhaps you can grow, like you said, the actions that are directly from your self concept. And if you can't change your self concept, your actions will never exceed your self concept ever. Your financial income will never exceed your self concept ever.
Wow, that's a great statement and a great way to think about it. I think one way people can think bigger with their own self concept, oftentimes it's overcoming an aversion to debt and early experiences with debt that temper a person's mindset such that they might not even want to take out a loan for real estate.
Well, that's a phenomenal example. That is the greatest example because I think if most people, when they think of debt, even I did when I was, younger, you think of it as a negative word. You think of debt as negative. And in a lot of cases, it can be. But, there's good debt, there's bad debt. There's also people that spend unconsciously in debt and consciously in debt. So it's very, very different. But for me and for guys in the circles that I'm in and you're in, we use debt. We use good debt to get really wealthy. The entire banking system is based on people giving them money through savings deposits. And so the banks are sitting there with all this cash. they have to lend it in the form of debt. And so if you understand how to use it, basically we're using OPM or other people's money. We're using people's deposits to go buy assets for ourselves. And it's really that simple. And again, people, they save, 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 save. They don't understand because they're fixed. They have, one of the things I like to say is they either have a fixed or a not fixed mindset. Which one do you have? So people that are savers that have a fixed mindset around that issue, they're not going to listen to you in any way. They don't have an open mindset at all. And so if they open their mind a little bit and said, yeah, that is how the banking system is, because it is. It's basically everyone puts money in the bank, and then the bank looks for guys like us to lend it, and so that they can make money on those people's money. So that's a form of debt. And if people thought of it that way, they would, unleash the shackles, and they would go, okay, I get it. So now what do I do next? They listen to guys like you and say, okay, this is how I would do it so that I don't lose it.
Yeah, I think the fixed mindset basically says that debt's bad and I'm just never going to change my mind on that. And the reason people think debt's bad, I think it comes down to the fact that most people growing up, they got used to having to pay their own debt. They had a car loan on their Volkswagen Jetta and they had to work overtime hours on the weekend just to make the payments on their Jetta. So they had to grind and they had to eat dirt or pound sand or whatever to go ahead and make their payment. But with real estate investing, you have the ability to outsource every bit of your debt, principal, interest, taxes, maintenance, all that stuff, and get cash flow on top of it. So you have the ability to outsource your debt and do something like put a 20 or 25% down payment on a $1 million 12-plex that provides cash flow. And Ken, you know this already. If it weren't for debt, I wouldn't be anywhere with real estate. We wouldn't even be talking right now. I'd still be working at a day job.
Right. We all would. It's the way the system works. And if you understand the system, it's really exactly like what you said, Keith. If people really could so their self-concept around debt. But by the way, my parents were this way. They could not wait to pay off everything that they had. There's nothing wrong with this, by the way. There's lots of, financial gurus out there like Dave Ramsey that talk about this. They're pay off your debt, pay off your debt, pay off your debt. In some cases that I think that you should do that, but debt is not bad. It should be used as a tool to go out and get you very wealthy. That's the entire reason for it.
Debt's a tool. A hammer could be used to bludgeon someone to death, or a hammer could be used to build a beautiful building. So debt is totally a tool. It's just completely based on how you use it, and it's not something to just get rid of every time. Well, we talk about the production of cash flow. Oftentimes one takes on debt to do that. Speaking of mindset, there's still a substantial mindset around most investors, Ken. Even when most people think about real estate investing, they think of investing for capital gains, buying an asset at a low price, trying to time the market and sell it at a high price. But there's really a mindset around cash flow versus capital gains. Can you speak to that?
Great topic, cash flow versus capital gains. I did a couple videos in my Jumpstart series about this. You're right. So just in its simplest form, a flipper is a capital gain strategy. So buy something, sell it for more, buy another one, sell it for more. Hopefully that works for them. At some point, of course, we all know it's not sustainable. So you really need to buy for cash flow first, and with also the understanding of keeping cognizant of capital gains. So I'll give you an example. Every single deal that I've bought right now, Keith, so we own about just right around $1 billion worth of apartments. And Ross, my partner, and I, we decided that we were going to sell our bottom 10. So we have 10 apartment complexes that, for one reason or another, our bottom 10, maybe they're low cash flow producers or whatever, or maybe like in one case, like in the city of Austin, we think Austin's at the top of the market, and so we're going to sell it. So we're cash flowing, for example, on that Austin deal significantly, but the capital gain side of it, we're going to get 4 to 5 million more than we would have just 2 or 3 years ago, because there's such an appetite for multifamily in Austin. And so you have to be cognizant of both. You don't want to do a cash call to your investors. You want to always have cash flow, and we have lots of it. And so now the issue becomes, what do we do with all that equity? That's a different question. So the cash flow versus capital gain, that's a great example. Whereas I also have other properties that are tight on cash flow. And if the occupancies came down at all, then I would be in a bad position of possibly feeding the property. So now I'm looking at that as, okay, well, why don't we just make a few $1,000,000 on this property and sell it to somebody else who thinks they can run it better than us and move on and redistribute that money. So paying attention to these two topics is very, very important.
So in the case of those bottom 10, you're selling relatively high. You're probably realizing a nice gain on those. But when we talk about cash flow versus capital gains, you didn't buy those for capital gains. You just happened to have a gain and you were enjoying cash flow all the while.
That's exactly right. So I've owned all those 10 deals anywhere from, say, 5 to 10 years each. We're selling them for right around $200 million. So we'll sell all of those. And as you know, we'll have a significant capital gain of probably somewhere between 70 and 80 million bucks of cash that we'll have by the end of the year that we have to figure out what to do with. But if I wait 2 or 3 years, Keith, that number could have been 20 or 30. The real estate goes up and down. And so sometimes you have to capitalize on the capital gain side of it and cash out and redeploy that money into underperforming assets that you can turn into some kind of a value add and do this all again. And so that's all the game is. It's literally like Monopoly.
This can be a great problem to have. What do you do with 70 to $80 million worth of capital gains? Because at some point it can get difficult to identify properties for a 1031 exchange and keep those timelines with such great amounts.
That's exactly what we're doing. Actually, we're taking those 10 and we're buying 6, and we're 1031ing and deferring the tax on all of them, and we're creating a fund. And so that's kind of what I'm working on right now. But yeah, so we have 16 transactions between now and the end of the year, so we're really busy.
What else can you tell me about cash flow versus capital gains? Especially, there's a certain mindset that goes into that. For one thing, when you're not investing for capital gains, well, if you invest for cash flow, it's difficult to become, I'll sort of call it a victim of timing. You can become a victim of timing if you're a capital gains investor. Oftentimes, if you're invested in these more volatile coastal markets rather than sort of some of these more stable inland markets that you and I invest.
Well, I'll give you a great example because it's current and something I'm doing. So I'm right now looking for a new house. And there's a home that I'm interested in, Scottsdale, where somebody bought the lot, tore down the existing house, and built this new house. And they had anticipated the market continuing to rise. In other words, so what they paid for the land, what the cost for the demolition, and the cost to build a new house is basically right at what they're asking. And so there's no money left in for profit for these people. And I'm actually going to offer them about 400 grand less than they're asking. So now this is the point of a capital gain. So there's so many people that do this on a small scale and big scale where they buy something and they hope the market's going to continue to go up. And as you and I both know, hope is not a strategy. It's completely guessing that next year's going to be better than last year. And so what we do, like you, is we try to buy for cash flow. So using that same property, you need to have some kind of tenant or reoccurring revenue in there so that you're at least covering your mortgage so you don't have the pressure of a buyer. You don't have to sell it. You can wait for the market. And so the cash flow gives you the relief of not having to have the anxiety and stress around selling something when you don't want to.
And if you're only into buying and selling real estate for a capital gain, that's certainly a strategy, and there can be a certain amount of success with that. But once you buy a property and then you sell it, well, you don't own any real estate in the end, and then you're often paying real estate commissions and make-ready expenses. Oftentimes, you can have 10% commonly whittled off your sale price for those two expenses alone.
Yeah, that's another great point. On a capital gain strategy, you have all those expenses, but I think the bigger one is tax. The biggest expense we all have in our lives is tax. And so depending on your tax situation, you could have a significant tax hit. So not only do you have all those commissions and things that you just mentioned and the fees for transactions, but any gain that you make, if you do make, is going to be taxed at your tax rate. So, at the end of the day, you could have 60% of that rolling to the next one and trying to do it again. And so that's all I'm saying. As you know, sometimes it's better to ride that all the way.
A lot of people just do not know about the 1031 tax deferred exchange. I was recently talking to a couple older investors, Ken, as my wife were on this vacation in Europe, and a lot of the people that go to the places we go are substantially older than us. And I talked to a couple real estate investors from Florida, and they're just a mom and pop real estate investor. And I was just talking to them about their investing, and they're kind of buy and hold, and then they hope to sell it for more. And they usually do have a capital gain, even though they're cash flow investors. But they mentioned to me how they don't do anything like a 1031 exchange because they just don't get fancy like that, and they don't mind paying their taxes. That was their mindset. That's part of their strategy.
It's funny. I mean, there's a lot of people that think paying taxes is patriotic and that they need to pay. And I pay plenty, don't get me wrong. But there are tools to help you mitigate your tax. And 1031 is, in my opinion, just one of the very best ones for real estate. And if it sounds to me like they don't understand it and they don't know it, because if they really did, Keith, they would look at it. You can 1031 from a house into vacant land, and you can go from a commercial to an office, into retail, into single family, into condos. And the law is phenomenal. It gives you a lot of flexibility.
Yeah, a lot of people just don't know any better. And if you think it's patriotic to pay your taxes, well, I think from the same vein, you can say it's patriotic to buy the IRS guidelines that your government sets up for you. And part of those guidelines are really an inducement and an encouragement to do a 1031 exchange and provide more housing for more people.
Well, right. Tom Wheelwright really well. He's a good friend of mine, and he wrote that book, Tax-Free Wealth. I think it's a phenomenal book. And I'll tell you, he educated me a lot. He said the tax code is basically a series of tax laws that tell you what you can and can't do. And it's really that simple. If you follow wealth, you will see that the money goes where the tax breaks are. So if the government wants, more oil production, they do a tax incentive around oil. If they want fuel efficient cars, they do a tax incentive around that. If they want housing, they do a tax incentive around that. And so paying attention to that is so important, because if you really want to see what the government wants, they put up these tax incentives for us to watch. To me, they're like green lights. You have to pay attention to them, and you should use them because that's what they are, and they're legal. As long as you stay legal, why wouldn't you? Why would you want to pay more tax?
I think Tom is probably the first person to point out to both of us that the IRS tax code and its 6,000 or so pages is basically just a treasure map to find out where all the deductions are.
That's exactly right. And so that's why you need people. I know you and I were chatting in some of the prior interviews and even this morning before this one on partnerships. And, Tom is my tax partner. He's the guy I turn to for these kinds of things. And having that kind of knowledge, I think a lot of times people try to do everything themselves. They want to know everything themselves, and they want to be the expert. I'm the exact opposite, Keith. I want to know what I know very well. I want to do what I do very well, which is invest in apartments. But I don't want to have to pay attention to legal and tax and all the things that swirl around those issues. I want to have people on my team. I want to have partners, part of my team that can help me with that.
Legal and tax are not my strong suit either. I rely on two other Rich Dad advisors to do exactly that for me. You're listening to Get Rich Education. Our guest is Rich Dad Real Estate Advisor Ken McElroy. We're going to talk about partnerships more when we come back. I'm your host, Keith Weinhold.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is Peak Prosperity's Chris Martinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Rich Dad real estate advisor Ken McElroy. Ken has so much experience with partnerships, and he's been burned a lot of times, and he's seen it all, and he's done so many deals in his long real estate investing career. So, Ken, just start to tell us about the importance of partnerships and how you get into the right ones.
Wow, that's a great question, Keith. As you know, I look at everything as a partnership, honestly. Some are deeper. Obviously, the ones I think of that probably a lot of people focus on mostly would be obviously a marriage, but also a business partnership. Very, very different behaviors. But going beyond that, I think that we have partnerships with our residents at our properties. I think I have partnerships with my contractors, my property managers, my employees, and the people that I rely on for day-to-day help on things. And as I navigate through the investment world, Keith, I think I have partnerships there, whether it's my financial planner, and I do have one, and I'm talking to him about gold or silver, or maybe it's Tom Wheelwright we talked about earlier with tax, or whoever, and I have a personal trainer. I think that's a partnership. I really do. That's how I think about everything. I think partnerships are so, so important, and they can be very, very good, or they can be very, very bad.
A lot of people think about partnerships only in the formal sense. Maybe you, the listener, are out there thinking, well, I'm not in any limited partnerships or general partnerships or whatever. But the property manager that manages your properties, that's obviously a very important partnership. You have a partnership with your banker. You have a partnership if you hire contractors. Really, you even have a partnership with every tenant that's paying you rent.
100%. Well, it's proved by a lease. I mean, right?
Right.
You have a partnership with them, and you're in partnership with them to pay on time. And what you need to do is maintain those premises in a safe manner. People don't think of life that way, but I do. I think of, in a lot of ways, my friends and my kids and everything that way. I mean, and not in a business rigid way, but I think, I have very different relationships with my kids. I have very different partnerships with them. So that's how I look at everything. And the hard ones are the ones where there's money involved and things like that, like with my partner Ross. And I have an incredible partnership with him. And we've been together a long, long time. And I think the key to all this, the underlying key to everything, is communication and setting expectations and accountability. Once those things are set along all those lines, whether it's a marriage or a business or employees or contractors, I think then it keeps partnerships strong.
You know what's interesting? They're at MC Companies, you and Ross, you're syndicators of apartment buildings and other real estate, and you own 10,000 or more apartment units. Even though your prospective property manager for your individual properties are maybe 3 or 4 levels below where you are now, you will still interview them personally because you understand how important that property manager is and what that partnership means to your success.
Well, if you think about it, yes, I do, Keith. Thanks. That's very, very true. I went through a time period when I was growing where I didn't do that. And so I learned. What I think happens is I want to make sure that the on-site manager understands, one, how important they are to the overall mission. Because I could take people's money and I could invest it. But if I don't understand from the operation standpoint what's going on a day-to-day basis and a week-to-week basis and a month-to-month basis, that all rolls up to money that the property manager is either managing well or not well. And so I made that mistake early on in my career. And so now I think that person, that on-site manager, is incredibly important component to the overall success of an investment.
Talk to us about finding the right manager.
it's the opposite of what most people think it is. I used to think that it was experience, and that's what I used to hire. And I think I do that with my own people at the office. So whether even in the non-property management business. So I'm part of a group called EO and YPO, been involved in those for a long, long time. And going back 15 years ago, one of the speakers was a guy by the name of Jack Daly. He talked a lot about hiring and hiring for attitude only. And so I switched what I was doing. I started hiring people for attitude. And as you know, from being around lots of people, whether it's sitting at a restaurant, getting waited on, there's people that come up to you that are really positive, and there's people that come up to you that are really shut down or whatever. And so, I started focusing more on that. And once I started focusing more on that, then my company started to get better. We were in the top 10 multifamily companies in the nation. We're certainly number one in Arizona. We're the top 50 employers in Arizona. All of that has to do with hiring people that have great attitudes, because my belief, Keith, is that you can bring anybody into anything. And if they have a great attitude, they're going to, just kind of like the money thing we were talking about before, they're going to say, how can I do that? How can I be successful in doing that? They're going to be looking at, and when they're done, they're going to go, that was fun. What else can I do? So hiring people that have great attitudes that don't necessarily know the business, to me, is not a problem. I would rather train them and send them off. In the case where I can find somebody that has both experience and a great attitude, then it's a win. It's as simple and easy as it sounds. Change my company, change my business, and change my life and my investors' lives.
You can train for skills, but you can't very well train for attitude. Anything else with vetting property managers? Do you usually take a referral route? I mean, how does that property manager even ever get to the point where they're in front of you?
Yeah, so I do. Yes, I usually try to get referrals. If I'm hiring a property manager in a different state, which I've done plenty of times, yes, I start with the referrals from the brokers and from the local apartment associations. And usually, like in anything, Keith, 2 or 3 people's names kind of resonate to the top. And that's kind of what I did. When I went to Portland, I did this huge project there. That's how we did it. We went around and we just basically said, who's the best in town for this? And over time, people that are in the industry, people's names kind of rise to the top.
So that's property managers, which is really kind of the glue that makes these investments stick together. But if you need to buy a property and rehabilitate it for a value add, we're talking about partnerships with contractors and vetting them. And oh gosh, it is just so common to have problems with contractors, and it's just so common for them to show up 30 minutes late with beer on their breath. How do you avoid finding that type of contractor?
Well, it's a great question. It's funny because in this particular area, I think people, a lot of times, they hire contractors based on their bids. The lowest bid, you got the deal.
Right.
And so I think that's a huge mistake. And I'm not saying you shouldn't be conscious of pricing, but a lot of times there's a reason why they're undercutting, or, because sometimes it might not be worth, it's happened to me. You hire somebody and there's not enough money in the bid for them to make anything. And so they're flaky. So I think it's a combination of finding out about, are they reputable? Have they done this work before? And again, doing references with where they've come from, but also to break down the bid and make sure that they're making money. You want to make sure of that. And I think a lot of times people don't care. And so that's when a lot of times they can get into those kinds of problems. The other thing, where you said where the contractor shows up with, let's say, beer on their breath or anything like that, that has a lot to do with the leadership at the top. And so if you're hiring a company that has service reps out there or people that are representing them and they're not doing a good job, then you're going to have that. But again, it's being very selective. And what I like to say is hire slow and fire fast, right?
Absolutely. And when it comes to contractors, oftentimes a big company has a higher price. But a big company, they have more labor at their disposal, and they are more likely to know their margins. And if they know that they're going to be making a reasonable profit, they're going to be less likely to cut corners. a bigger company, they're going to be companies that are less likely to ask you, the investor that's rehabbing a place. They're going to be less likely to ask you for something like a really big upfront payment, like asking for $10,000 up front, because a small company, they might not even have a credit line anywhere. So they're going to be looking for an upfront payment from you for $10,000 to buy drywall and plywood. Well, that could be a red flag right there.
Yeah, you're exactly right. If you're fronting money for them to buy supplies, you're tight. It's happened to me. That stuff, sometimes it makes it to your site, sometimes it doesn't. If it does, sometimes they're having a tough time finishing the work because they're managing a whole bunch of things. And so they basically have a team of one. And so you said it, if sometimes, not all the time, the bigger contractors can be higher in price. But like I said, you get what you pay for it. I personally, especially if it's a big, big project, I want to hire somebody that has a deep bench.
Well said. And there are some types of work where if I collect bids, I actually look at the higher bids first prior to the lower ones. Is sometimes I take those more seriously. And one other little trick I like to do is I like to request quotes rather than estimate. It's just a little thing. It might not matter, but getting a quote rather than an estimate might give you a little bit more leverage down the road if something goes haywire.
Yeah, I mean, everything's negotiable. So I usually take multiple bids and sit down with all of them, and I mean, I do this with real estate deals. When I was telling you about the portfolio that we just put out, we had 45 offers. And so we went through 2-3 rounds of best and final, and depending on the deal itself. And so that's an opportunity for you to communicate with whoever is trying to land the bid or get the quote or whatever. And that's how it should be. It should never be, okay, let's move forward. It should always be, whenever you get something from somebody and you get 3 quotes or bids or estimates or whatever you want to call them, and they're going to be very different. Like for seal coating, for example, some are going to have different levels of patchwork and different levels of seal coating and different kind of mixes and things like that. And that is the part where you're supposed to be. You're supposed to get in and make sure that you're all apples to apples, because most of the times I've found bids are very different from an apples to apples perspective.
That's a great point. Real estate is so quirky and irregular and inefficient in some ways, and it really takes some knowledge just to put 3 quotes or estimates together to get a fair comparison.
Right. And when you do, it's actually knowledge. You're sitting there looking at the 3, and you don't have to be the expert. You just have to ask them and say, well, I had another bid that included this, and is it that you missed this or that you don't think we need it? You know what I mean? And so that's, to me, that kind of gets everything kind of apples to apples or all on one even playing field.
We've talked about partnerships with property managers and with contractors. What about partnerships with tenants? They are effectively your partner. Is MC Companies doing anything differently with vetting tenants? And what exactly are you doing?
Well, yes, we haven't changed anything in the last few years, but Keith, we think that finding the right tenant or resident is the most important thing, because all your problems come from that one decision. And so obviously we put out an application and they have to fill that out. We try to make them do at least 3 to 1, which is called their income has to be at least 3 times the rent. And then the deposits, we vary based on whatever their credit history might have been, et cetera, et cetera. If they've had evictions or something like that, those are usually red flags. And a lot of people, a lot of times, don't pay attention to those things because they're desperate. They have a vacancy loss. They're trying to cover it. And in addition to that, we do criminal background checks. So we don't want convicted felons in our properties. And that's just our policy. Not everyone has that policy. And there are convicted felons that are doing just fine these days, but that's just our policy. And then we also run a sex offender check because we don't want sex offenders in our properties. So those are the things that we do. And so what happens is, hopefully, we're not in a position, Keith, where we're actually having to evict anybody. That is something that I don't want to have to do. And, we have 10,000 tenants.
Cash flow and income all come from tenants. That's really one of your more important relationships and partnerships. Even though it's a lower level one, you just absolutely can't overlook it, because that's what really makes this thing happen. So, Ken, people are often interested in knowing what you're up to and what's coming next. What's next for you and NC Companies late this year and into 2019?
Well, I'm having fun right now doing these KenMcElroy.com videos. And Keith, honestly, that's been a blast because it's taking 30 years of investing in property management and entrepreneurship and putting them into these short videos. They're free videos on my website at KenMcElroy.com. That's been a lot of fun, just being able to educate a little bit on some of the mistakes I've made over the years and all the things. And we're growing very, very fast. And most of the videos I'm doing these days are from requests from our subscribers. So that's been really fun. I'm in the process of finishing up another book. It'll be my 5th book. And that's kind of along this mindset and real estate investing idea that we talked about. And then we have $300 million worth of real estate trading, in the next basically 3 months. So we're very, very, very busy and putting together a fund. I've been back and forth to Wall Street with Goldman Sachs and Blackstone and kind of negotiating things with them for, bringing in some institutional equity. And it's been fun. It's kind of, super busy these times.
You've always got a lot of irons in the fire. Yeah, I really suggest checking out KenMcElroy.com. Get Ken McElroy's 30 years of experience there in really easy to consume bite-sized videos.
Keith, I want to thank you for all the education you're putting out there. I think I want everyone to achieve financial success. I do. That's my overall goal. And I think there's enough room for everybody to do that. And I want to congratulate you on your success as well.
Well, thank you. There's plenty of room for that. That's the abundance mentality. Ken McElroy, thanks so much for coming back onto the show.
Of course, Keith.
Yeah, great stuff from Ken as always. If you got great value out of today's show, I would be so grateful if you take a screenshot of your podcatcher with the show playing here and post it on your favorite social media platform, your Facebook or your Instagram or your LinkedIn. Until next week, when I'll faithfully return to help you build your wealth, for Rich Dad Real Estate Advisor Ken McElroy, I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
As America's 3rd largest city, Chicago, Illinois has big economies of scale for real estate investors. But there are problems with investing in highly taxed, fiscally strapped Illinois. You can beat it when you invest in Chicago land, staying on the Indiana side of the state line. Your property tax on a median Indiana home is less than half that of an Illinois property. Forbes ranks Indiana as one of the top 10 states to do business. With typical rents at $1,250 and purchase prices at $125K, Northwest Indiana numbers work. Learn more and connect with the turnkey provider at GetRichEducation.com/Chicago. That's GetRichEducation.com/Chicago.
71% of Americans aren't saving enough for retirement. It's going to get worse as people live longer, and you need to start thinking differently. But you can't lose your time. Real estate is the investment vehicle that's made more ordinary people wealthy than anything else. Keith Weinhold of Get Rich Education is host of one of America's top investing shows, Disrupting Wall Street. He's an international best-selling author, a writer for Rich Dad Advisors, and has been an active income property investor since 2002. He has created thousands in passive monthly income for countless followers, and now he has a free book, The 7 Principles for Creating Wealth in Your Life. Get your copy now at GetRichEducation.com/book. That's GetRichEducation.com/book. Because invest in what produces income for you now and later. Sign up now at GetRichEducation.com/book.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.